So why go the route of an SDIRA? The number one reason here is the opportunity for a better portfolio, simply put. So the number one reason, have a better portfolio. The primary reason is to consider the fact that when you gain the opportunity to maintain and control your investments, you will have access to more opportunities like alternatives and real estate. Most traditional IRA managers don't offer alternatives to stocks and bonds. You're stuck. The menu's limited. It's small. Welcome to another amazing Saint webinar here on today's topic, the IRA Insider Playbook. All right, taking a look. I'll give you guys a quick update on some fun market stuff. The first, retail real estate. I have a soft spot for retail real estate. It's had a lot of bad news in the last few years, but we're starting to see some silver lining. This is good for a few reasons. U.S. retail and real estate volume in Q1 2025 grew 13% year over year. General retail led positive absorption with vacancy rates at just 2.6%, while grocery anchored centers continued to benefit from their essential service positioning. For those that don't know, I actually started in retail real estate, which is, I don't recommend it. It's probably the worst leasing environment you could ever imagine. Every deal takes 5 leases. It's very, very hectic on the leasing side, but it's like a masterclass in leasing. So I'm also very blessed and thankful for that. And last news piece, real quick, small business optimism. This is one we track very closely at Saint. The National Federation of Independent Business delivered encouraging news with their small business index, the small business optimism index climbing to 98.8%, which is above long run averages for the first time in many months. Also, capital spending plans by small business hit a 2025 high at 22%. So for those that have been following us for a little while, you know that we're very bullish on two parts of the market. We like small businesses. We love small businesses in the US. It's a driver for many of the biggest things in the US economy. And we love industrial and manufacturing in the US. Small business ties in very heavily to both of those. So things like mortgages, things like optimism, things like spending in the US are closely tied to these. So thought I'd give you guys a quick update. Hello for those still piling in. Last question. I really want to get your guys' insight. What do you think interest rates will do for the rest of this year? And I have a secret for you. I'll give you some updates shortly here, and we'll show you some fun charts and graphs, maybe some insider knowledge, somewhere you can look to get updates on this directly from the Federal Reserve. So what do you guys think rates will do this year? Go up, go down? Let us know what you think. Wayne, I think interest rates will remain unchanged for the year. Very interesting. I think there's pressures both ways. So we'll see what weighs out here. Still a lot of people piling in. Welcome to the newcomers that are just jumping in now. Linda, good to see you. Nancy, Robert. Jim says unchanged also. Jorge slightly down. Interesting. Good. We appreciate your guys' insight. All right. Let's kick things off. Let's hop into some fun stuff here, huh? So today we have the IRA deep dive from Saint Investment Group. Today we're going to cover how to secure recession-resistant returns using your IRA. What we'll cover today is what is an IRA. We'll start all the way at the beginning. We'll cover the basics so that you guys can get some comparisons on not just the traditional IRAs, but the subtypes of IRAs, the pros and cons of each, how to convert your IRA to a self-directed IRA. So we'll give you some strategies that you can implement in your portfolio to give yourself a leg up and have access to a lot more opportunities along the way. And then the IRA market, what that looks like, and some advantages and opportunities that you can utilize, including some portfolio breakdowns that some of the biggest institutions and investors are using in today's market. I'm really excited for this one. But first, in case we haven't gotten a chance to meet yet, my name is Nick D'Angelo. I am president of Saint Investment Group. I'm blessed to be considered a thought leader in the real estate space, investment, economics, etc. I get to talk about these passionate, fun topics all over the place, podcasts, stages across the country. It's one of the things I get the most joy out of is going absolutely deep on fun topics that at the end of the day, we can take action after and analyze what we can do to make more. Is it not? Oh, is the slide deck not showing here now?
No, not yet. I sent you a private message. I was like, he's really diving in and we can't see it.
Yeah. What about now? Is the screen up? Leslie, can you see it? You can see it?
Leslie said I can see it. I can't see it, but I don't know. Okay, if everybody else can see it. Oh, I can see. Okay, great. Perfect.
Okay, I might be pinned on your end, Ange, but I appreciate it. Okay, everyone could see the slides, right? We're all good? We got visibility on slides?
I can see it, Nick.
Okay, great. All right, we're all good. So just a quick background of Saint, a lot of hard work, an amazing team, over 600 mortgages in over 29 states and growing, over 200 million in assets under management, and our flagship fund, our Saint Income Fund, pays up to a 14.28% return. And the last stat that I'm extremely proud of is we've never missed a distribution in over a decade. So this webinar today is very personal for us because of how many of our investors utilize IRAs to invest with us. We have a whole slew of amazing questions that we've had along the way. And just like normal Saint style, if we get the same question multiple times, we make a whole webinar on it. We're going to dive all the way in for you guys so you can get the full picture. Oh, I love this slide. One of my favorite slides of all time. This is simply put a brag slide. It goes over a lot of hard work by the Saint team to produce for our investors, the most important thing. Again, we have over 600 mortgages, over 29 states, over 131 months of on-time distributions, which led to over 14 million in distributions to our investors. But don't take our word for it. I'm the biggest fan of Saint. But most importantly, I always recommend that people take a look at what others have to say, what our investors have to say. There are a lot of reviews online that should give you guys a great insight of to how we do things, how we treat our investors. I recommend two places above all others, Trustpilot and Google. Trustpilot and Google have a ton of reviews from our investors that you can see directly from them how their experience was with Saint. So highly recommended to take a look at that. And then as a reminder, we are a great option to consider as we go through this, paying returns up to 14.28 with a 28% with a great portfolio. But I want to introduce you guys to Tom Furlong, an amazing member of the Saint team, a ton of value, works directly with investors. So if you haven't gotten a chance to talk with Tom, he'll hop up now. Tom, can you say hi and tell everyone a little bit about you?
Absolutely. Yeah. Thanks, Nick. As Nick mentioned, my name is Tom Furlong. I'm the Director of Investor Success here at Saint. And thank you guys for taking the time out of your schedule to join us. We are so excited to be able to talk to you all here tonight. I actually work with IRA companies every single day. So helping to coordinate different investments or documents or rollovers. So I'm happy to be a resource. If you are interested in self-directing your IRA or 401k into private placement, I'll actually link my calendar here in the chat. So feel free to book a call with me directly. We can discuss in depth about your specific situation. And we will also be doing a Q&A at the end of this call. So if you have any questions directly for Nick, I empower you to raise your hand in the chat, turn on your camera so you can have a direct conversation with Nick. It's such a great opportunity. If you don't have any questions and you decide that you'd like to invest during this webinar, I will be available during this call. My direct number is 949-658-3378. I'll put that in the chat as well. And we are thrilled to partner with you. If you're a current investor, we're thrilled to continue growing our partnership. Again, that's 949-658-3378. And my direct email is tom, at saintinvestment.com. And I'll put that in the chat right now.
Tom, I appreciate that. Again, Tom is an amazing resource. He has a ton of insights, not just on the IRA side, which he has a ton. He works with IRA groups every single day, so he can give you guys a lot of insights and support on that side, but also on the investment side. The reviews on Tom, investors love him. We learn new things from him every single day, and he's crushing it on the Saint side. So as a reminder, Tom said this, but as a reminder, at any time during this call, if you want to connect with Tom directly, you can call him with the number in the chat now, or his link to his calendar is in the chat as well. So you could book a time later on that might work better for your schedule if you're not able to connect with him now. Thanks, Tom. Appreciate it. All right. We'll keep rolling through here. So basic structure from here. Let's do an overview. First, we'll start off with a legal disclaimer. We'll keep the attorneys happy. Then we are going to deep dive on the IRA topic for today. Then we'll shift to some housekeeping and go over some updates on the Saint side. And then we are going to end with arguably one of the most valuable pieces of this webinar, which is the live Q&A, where we get to talk about any topic that's on your guys' mind, whether that's something very personal for you, whether that's something market related, investment strategy related. We have a ton of good insights, not just from your questions. I encourage you to ask questions during this, but you'll also get to hear from others. So there's a lot of value there. All right, let's jump into our legal disclaimer. I encourage you guys to read through this, but here are the big highlights. 1, this is not investment advice. 2, this is for educational purposes only. And 3, all investments carry risk. Past performance does not ensure future results. And for those just joining us on our first webinar together, we have something that we have, we've done this for half a dozen webinars at this point. We have a Saint book giveaway. I love this piece. What this allows us to do is put amazing books in front of you guys so that you can read some good insights, some things that will sometimes challenge your understanding of the investment world, sometimes add to it in different ways that you didn't consider. But this book today, Killing Sacred Cows, is very special. The way that we can give this book away is to encourage engagement. We want to hear from you guys. We want to connect with you guys. And there's 3 big ways that you can do that. 1, comments and questions in the chat. If you have comments or questions along the way, drop them in the chat. For questions, if I can answer them on the spot, I'll jump right in. Otherwise, we will keep them and compile them in a list for the end for our live Q&A. 2, responding to polls. Polls are extremely powerful on webinars. It gives not just us an idea of where you guys are at and where your heads are at, but it gives you guys an idea of each other and what you're seeing. So it's kind of a group effort that pays a lot of dividends for everyone. And then 3, leaving reviews on Trustpilot. So we love to hear from you guys. We love to hear from your experience. And if today was valuable, we'd love for you to leave a review on Trustpilot. Ange, do you mind dropping the link in the chat so they could check out, not just leave a review, but also check out other investor reviews? And so, Killing Sacred Cows, the book in front of us now. This was recommended to me by someone I have the utmost respect for, a dear friend of mine. And the concept of this book is thinking differently about some of the biggest financial decisions we'll make throughout of our lifetime. This includes insurance. This includes investing. This includes retirement. This includes family planning. Really, really important stuff that we hear kind of the same shtick over and over. This book breaks those down in really interesting ways and offers challenges to each one of those. So we'd love to give this away to you guys, for comments and questions in the chat, responding to polls, and leaving reviews. But if you aren't here for the whole webinar, or you just want to buy the book right now, we also included a QR code so that you guys could just buy it on Amazon. We don't get any kickbacks or anything, but we just wanted you to have the resource and be able to get there. So we talked about rates earlier. Before we jump in, I wanted to check in with you guys on interest rates and give you a quick update. We typically do this on every webinar to give our investors an update of what's happening with rates, as these have a big impact on businesses and investing. What we're looking at here is a chart of the federal funds rate over the last year. And what we've seen over the last year is roughly a drop by 1%. If you're wondering why the federal funds rate is lower than interest rates in, say, single family mortgages, et cetera, it's because for consumer loans like mortgages, we commonly see about 2 to 2.5% higher rates for us buying a house than we would see in the federal funds rate. So today, the average mortgage rate is just below 7%, which is on track with what the federal funds rate correlates to the single family mortgage market. Remember, as rates go lower, it stimulates buying and investing. So it stimulates the economy. This is good at certain times, but all that buying also stimulates inflation. It stimulates demand. It rises prices, right? Which we've been battling since 2021. So rates have stayed higher to slow things down, but we're now seeing rates start to come down a little bit over the last year. So what is going to happen with the future of interest rates? While we don't know with 100% certainty, we do have the Federal Reserve's dot plot chart. This is a very powerful tool. So in this chart, we see exactly what the Fed tells us that each member of the Federal Open Market Committee, so directly from the people making much of our policy, what they expect to see over multiple periods of time. What we see is that the averages of multiple time periods over the next 6 months, for instance, we see that the committee is thinking that interest rates will drop by 0.5 percentage point, and over the next 2 years, a total of 1 percentage point drop is expected by the Federal Open Market Committee. So for reference, we'll give you guys, I love this poll. So the Fed has maintained its current interest rate at the most recent meeting. What do you see as the biggest factor preventing the Fed from cutting rates sooner? We'll let you guys drop that answer in the poll. Tariffs, all the above, strong labor market data. Lots of votes. Good to hear from you guys. Persistent inflation. Can you guys see the results? Can everyone see the results? I'll pull them up here just to put it on screen. This is a good breakdown. So in first place, we have geopolitical instability and tariffs. In second place, we have all of the above, meaning inflation, labor, geopolitical, et cetera. And then in third, we have persistent inflation concerns. Awesome. Thank you, guys. Good to hear from everybody. Okay, so what does this dot plot mean? It means that over the next 2 years, we should see mortgage rates, for instance, just using the most common example, drop to around the 5.5% range by the end of 2027. This is very interesting, and it actually puts mortgages in range of the historical average of that 5 to 6% range. Personally, I believe inflation is going to be a lot stickier than what the news is covering, and many big names in finance agree. Bill Ackman, Howard Marks, etc. So we will be keeping a close eye on this and give you guys some good insights along the way on the rate market. So you've got an IRA. Is it working hard enough? This is the first question I want you to ask yourself, and one that should be in the back of your mind, not only regularly, but throughout this presentation. This webinar is a continuation of our Investor Resources series. And what this series is a bulk of webinars that go over the most common questions we get from our investors. So we've done this on things. We've got a question consistently on what is Saint's due diligence process. So rather than answering that question lightly over and over, we did a huge, massive deep dive into mortgages, into the mortgage industry with our mortgage investing masterclass. And we created a huge focus on our personal due diligence process. So today's webinar is similar. Our goal today is that you walk away with an understanding of what IRAs are, how to use them, what the best strategies are to consider with your IRA, and what the biggest takeaways are that we've seen from our investor community. So we got a lot of good things in store for you guys. So what is an IRA? Let's jump in. An IRA, or an individual retirement account, is a tax advantage savings plan designed for retirement. It allows you to save for retirement with potential tax benefits such as tax deferred growth or tax-free withdrawals in retirement. Individual retirement accounts were created by the Employee Retirement Income Security Act of 1974, or ERISA. What this did was set minimum standards for most health and retirement plans in the private industry in the US. The goal was to increase the amount that Americans saved for retirement. All right, so let's take a look at some IRA stats to get an idea of the size. 44% of US households have an IRA. So that's roughly 58 million households throughout the US. Traditional IRAs make up about 25% of this, while Roth is right around 33% of the total IRA market. Self-directed IRAs can be either traditional or Roth. We'll dive in a lot on SDIRAs, and represent only about 2 to 3% of IRAs today, but growing rapidly. So what is the advantage of using an IRA? These were created to support retirement savings by workers without employer-sponsored pension coverage. So that was the initial start of IRAs. So a quick note on why. Well, for one, pensions were the standard for many years in the US, right? You worked at company X for X amount of years, you got a pension. You worked at General Motors for 30 years, then you got a gold watch and you got your pension, right? The IRA structure lets you have more control over your retirement and gave us another option rather than a pension. This lets you also have more control over your career because you aren't stuck with one employer for a lifetime and risk losing your retirement benefits. So how does it work? Well, workers deduct, the original structure was that workers would deduct their IRA contributions from their taxable income and instead pay taxes when they take the withdrawals. That's the traditional structure here. Contributions must be made from earned income. Investors must also take a required minimum distribution annually starting at a specific age. It's kind of based on the year you were born, but it's between 70 and 75. The Economic Recovery Act of 1981 opened eligibility for workers with pension coverage from an employer. So now there was a system where you could have both a pension and an IRA, a double benefit for workers. Pensions over time have dwindled quite a bit in the United States, but the IRA structure has stayed as a cornerstone of retirement in the wake of the pensions declining. This is a powerful chart, and this is a good idea of the history here and where we're at today in the growth of IRAs. Most importantly, it tracks adoption over time. It also shows the periods that big improvements and expansions were introduced to the IRA structure overall. So at each point, this continued to increase IRA adoption. Let's walk through the chart a little bit. So the beginning, 1974. Interesting point. This was only 3 years after we took the US dollar off of the gold standard. Interesting point historically. But we can see 0 people, brand new program, only available to workers without employer coverage. 1981, we saw 2 million people get involved. Eligibility broadened to all workers with earned income. So they expanded the program. They took an expansion there. 1990, continued expansion with lots of growth, 15 million people growing in popularity. Now in 1997, this is a big year. This is the year the Roth IRA was introduced. And also the self-directed, the SDIRA, was introduced in 1997. 2010, there was a big growth. Starting in 2010, there was a big growth because the post-financial crisis growth. It was a large focus on retirement security. People were concerned about the wake of the 2008 global financial crisis. They wanted their retirement to be shored up with as many means as possible. In 2024, the last full year we have on record for IRAs, 58 million people, 44% of US households. So let's go over some notes on IRAs. Let's start poking around at the foundations and some of the terms that IRAs require. You have to wait until you're 59 and a half to withdraw funds without a penalty. That's an important note. If you do so before the age of 59 and a half, you have to pay a 10% penalty on your withdrawals. Also, there are some penalty exemptions, including higher education like college, first-time home buyers, some medical expenses, disability, health insurance, etc. There are some exemptions that would allow you to withdraw before 59 and a half without paying that 10% penalty. Now, let's get into the nitty-gritty here, right? IRA subtypes. We're going to go one layer deeper and take a look at some specifics. There are a number of types of IRAs with a lot of pros and cons, so we're going to cover the highlights. The first, traditional IRAs. This is the standard where workers contribute pre-tax income and benefit from the tax deduction on the front side. The typical max contribution annually is $7,000 a year below age 50 and $8,000 above the age 50. So earnings grow with taxes deferred. So you got to pay taxes later. And participants can pay taxes when they take their withdrawals out. Early withdrawals, again, result in penalties. Here's a note. You're boxed in a little bit on this because at one point, account holders must take minimum required distributions after the age of 73 to 75. Here are the pros and cons of the traditional IRA. Pro number one, tax deductible contributions. You can reduce your taxable income if you meet the income limits. Number two pro here, tax deferred growth. Earnings, interest, dividend, capital gains. These growths are tax deferred until you withdraw in retirement. This allows you to compound annually without current year tax drag. That is one of the biggest points of a traditional IRA and really many IRAs in general. The cons of a traditional IRA, taxable withdrawals in retirement. Okay, so every dollar that you withdraw is taxed as ordinary income, which can lead to a large tax bill. This can drag down your returns and drag down how much you experience for your lifestyle and covering expenses in your retirement years. Next is required minimum distributions. You have to take money out, even if you don't need it, which will, again, also increase your tax liability. And then we talked about the early withdrawal penalties, but that 10% penalty, if you need money before, you're going to get hit. The Roth IRA. So this is a strategy that we see many people use effectively. What's interesting about Roth is that contributions are made with taxed funds, but on the back end, earnings grow tax-free. So in this case, you pay the tax up front and then pay no taxes when you withdraw. So participants can withdraw their contributions at any time without penalty because they have already paid the taxes. Earnings can be withdrawn tax-free after the age again of 59 and a half. The Roth was created in 1997 by the Taxpayer Relief Act, which also formalized SDIRAs. That's the fun point we're making here. Pros to the Roth IRA, tax-free growth and withdrawals. This is by far the number one benefit. Number two, there is no required minimum distribution for the original owner. So unlike traditional IRAs, like we just covered, Roth IRAs have no required minimum distributions. So you can leave the money in there as long as you like. You don't have to take something every year. And then also there are flexible withdrawal rules. You can withdraw your contributions, not your earnings, but your contributions at any time. tax and penalty free. So this gives you a lot more flexibility in your own financial planning and in the case of an emergency. So what are the cons to a Roth IRA? One, there's no immediate tax deduction. The contributions are made with after-tax dollars, so you've already paid the tax. You don't get that benefit up front. And number two, there's income limits. So many of our investors are high net worth, high income individuals, so there are income limits to consider here. But at this moment, I'll take a second to recommend that you check out a backdoor Roth strategy. It's beyond the scope of this IRA presentation, but for high income, for high net worth, for high earners, this is a great thing to consider along the way and will allow you to have access to a Roth structure if set up properly, even if you're in the higher income brackets. So let's take a look at the IRA versus the SDIRA, the self-directed IRA markets. As of late 2024, self-directed IRAs account for approximately 2 to 5% of all IRA assets in the United States, which is roughly $324 billion in value. The SDIRA market has seen an estimated annual growth of about 10% over the last 30 years. So it's ramping up. Projections are indicating continued expansion as more and more investors roll over retirement funds from other IRA plans. What we're talking about is the rise of the self-directed IRA. More and more people are transitioning to this structure. So now let's compare the IRA market with the global alternatives market like real estate. The number one thing to note is rising awareness. So industry reports and custodians, the IRA custodians that we work with and that you work with, note a marked increase in both awareness and adoption of SDIRAs, especially as baby boomers reach retirement age and seek to diversify beyond the traditional stock and bond investments of previous generations. Baby boomers are sophisticated. They are the wealthiest generation that we've ever had in US history, and they are seeing more and more opportunities outside of traditional investing like stocks and bonds. Alternative asset demand is now soaring. The global market for alternative investments, which is a key driver for SDIRAs, is projected to grow at roughly 12% annually, and we've seen that since 2022, and we expect it ongoing into the future. This is nearly doubling the size and further fueling SDIRA adoption. So what are the takeaways? Alternatives are growing rapidly. This is actually a generational issue. In the past, the baby boomers often targeted around roughly 5 to 10% of their portfolios in alternatives and real estate. This is increasing quite a bit year after year, and they're investing more into alternatives like real estate. What's interesting is that later generations have increasing trust and interest in real estate and much less trust in traditional markets. So we're starting to see markets shift. This is caused by a lot of factors, but think about millennials, for instance. Multiple recessions, 90s recession, dot-com bubble, global financial crisis, 2020 stock market crash, 2022 inflation reached 9.1%, and on and on and on. Trust in large companies and large institutions has gone down over time, especially for later generations, while trust in real assets, hard assets, true assets like real estate and other tangible investments has continued to gone up, especially with the younger generations, but also the boomers. What we're seeing now, the net result of this, is that polls are showing that millennials have up to 3 times the trust in real estate as previous generations. And their portfolio allocations and future investments are also showing roughly a 3x allocation as well. So boomers are continually and consistently shifting more money to real estate and alternatives in general, and younger generations are doing the same thing, but even faster and even more of their portfolio. This is a trend to keep an eye on. So, how is a self-directed IRA different? Let's cover self-directed IRAs. Let's take a deeper dive into SDIRAs. This is the most common structure that we see at Saint for the most sophisticated, most successful investors that they utilize. Why? Because it gives you the most flexibility and gives you access to a whole new world of investment opportunities. As we've mentioned in other webinars, I don't know, probably a handful of times at this point, the stock market has seen a reduction in the number of companies in the stock market by over 40% since 1995, meaning every single year, the stock market gets less diversified. And it also gets more and more risky as prices of stocks and price to earnings ratios have seen huge increase over time. What's interesting, while the stock market has declined, private investment like PE, et cetera, private equity has seen a 6x increase in the number of companies that are now working with private investment groups and choosing to not go public. So over the last 30 years, more and more of the best investment opportunities are going to the private sector. They're choosing not to go into the public markets. So with certainty, having the most control and access to the most opportunities through your IRA has never been more important than right now. So what comes next? The first step for an SDIRA is choosing a qualified custodian. Like I mentioned, SDIRAs are about freedom and control for you as the investor. So let's do a quick pros and cons analysis of the self-directed IRAs. Pro number one, you can invest in alternative assets like real estate, private businesses, mortgages, et cetera. But you can also invest in stocks and bonds. So massively more options, and the options in the higher returns and the safer asset classes as well, versus things that are more volatile like stocks. You also have greater control and diversification. So this gives you hands-on control of your investments, and it allows you to diversify your retirement savings beyond traditional stocks and bonds. The SDIRA is still tax deferred or tax-free growth. So earnings can grow tax deferred like a traditional SDIRA, or they can be tax-free like a Roth SDIRA. Both allow tax advantaged wealth building. And the last, opportunity for higher returns. I cannot highlight this enough. Savvy investors are earning returns that outperform standard markets because they have more opportunities and more access to better investments. So what are the cons of a self-directed IRA? One, more complexity and more responsibility. This is the number one point to make. You must do your own due diligence in this structure. There is more onus on the investor to choose their investments and dig in to that option. Also, this note is kind of hit or miss, but it is a good note for many options in the SDIRA world. There's often less liquidity. So many alternative investments, for instance, real estate or private equity, they take time to sell. They have maybe longer lockup periods. So oftentimes certain SDIRA investments may not be as accessible as quickly. Okay. That said, we're seeing funds do some interesting things. We're seeing some private investments do some interesting things. So at Saint, we heard our investors. They brought this up multiple times. They really wanted some flexibility along with their investment. What we did as an example of a private investment group and how we structured it to our investors' benefit, what we did is had different tiers set up with different time periods. So our investment terms, our initial terms of investing range from as little as 6 months all the way to 36 months. This gives our investors a lot of flexibility. And we also set up a structure on the back end where they weren't immediately locked into a long term. So instead, after initial terms with Saint, for instance, our investors can keep their funds in as long as they want, as long as they prefer, get the same rate of return. They just have to give us a 90-day notice. So there are structures out there that after the initial term have a lot of flexibility. I encourage you guys to look for these when you're looking at SDIRA options, because there's still a lot of flexibility if you look closely at good opportunities. Let's take a minute and break down the SDIRA process a bit to help you understand how it works. Step one, you choose a custodian. This is fully up to you, but we can always recommend some if you need custodians to consider. We get to work with a lot of them with many different investors. Offhand, the two that we've had the best experiences with are Equity Trust and Advanta. So a good note on your guys' side. We don't make any money. We don't get any kickbacks for that. That's just some insight that might give you some opportunity to look at some groups that we have good experiences with. We also have several reps over there. So if you ever wanted an introduction, I would connect with Tom. He's on a very, very close basis with those individuals and can get you connected with them directly. After you choose a custodian, next you will fund your account and transfer the amounts that you want in your SDIRA. From there, you'll go through their setup, their compliance processes, and they'll make sure that your account is correct and on board for the IRA requirements, IRS requirements, etc. And then last step here, you're in the driver's seat. You can research and select the investments that you would like to invest in and that you would like to include in your IRA portfolio. So it's a pretty straightforward process overall, but the custodian is the first step, and the custodian that you choose will make all the difference for you in the setup process. So what exactly is the role of this custodian? What does the specialized custodian actually do? So there are many custodians out there. Many of them have great teams. Their responsibilities include holding title to the assets on behalf of the IRA. This is a regulation and compliance term. They must do this. Another is processing transactions, such as property purchases, private placements, investing with investment groups, etc. These are directed by you. So you're still in the driver's seat. They do this on your behalf. Next is they ensure compliance. The IRS, etc. They make sure that the transactions that you make are on board and check the boxes that the IRS needs. And the last, reporting, contributions, distributions, the value of your IRA, etc. They cover these things for you to reduce headaches and to make sure you're compliant. So why go the route of an SDIRA? The number one reason here is the opportunity for a better portfolio, simply put. So the number one reason, have a better portfolio. The primary reason is to consider the fact that when you gain the opportunity to maintain and control your investments, you will have access to more opportunities like alternatives and real estate. Most traditional IRA managers don't offer alternatives to stocks and bonds. You're stuck. The menu's limited. It's small. We know the typical portfolio is invested in some form into the 60-40 portfolio concept. What we've seen as we've dug into the data, and we're about to show you, is that the 60-40 portfolio is outdated. I encourage you guys, if you want to see a deep dive on this, we have an entire webinar on portfolio breakdowns that also analyzes in a good amount of detail the 60-40 portfolio. But we'll give you guys some details now. For decades, the 60-40 portfolio represented the cornerstone of portfolio theory, especially since the 1980s. It was developed by Harry Markowitz in the 1950s, and this guy even received a Nobel Prize for his work. There was a lot of advantages to this structure for many years. Here's the philosophy behind it. The growth potential of stocks is balanced with the stability and income of bonds. Simply put, 60% stocks, 40% bonds. Long-term capital appreciation was represented by stocks. Income generation, preservation, portfolio stabilization, that was the bond aspect, that 40 of the 60-40. Simply put, it was a very simplified portfolio that allowed people to implement it well and easily, and it wasn't that complex. But the 60-40 portfolio has changed. The market fundamentals since the 80s have shifted dramatically, and the risks and benefits of the 60-40 portfolio have gone in the wrong direction. What we can see here is that previously, old regime versus new regime, right? Blue versus orange. We see that the return profile of the 60-40 was 11-ish, around 11. So strong returns. That's a good situation to be in when your volatility is only at 8%. We have seen these numbers flip. We now see a return very much around the 4% range for the 60-40 portfolio, while the volatility has skyrocketed at the same time. Why is that? Why is that? Let's look into the drivers of the old era versus the new era and why those have shifted. The old era, higher returns, lower volatility, cheap credit, cheap rates, post-recessionary growth. Things were going off the charts for, decade plus. Low inflation, low unemployment, low geopolitical risk. Overall, there was a ton of market support. That's the takeaway. You even had massive government involvement like quantitative easing and stimulus packages, even when we were pretty much on good footing at many points. The new regime has changed. The new world, the new era has changed quite a bit in the last half decade. We are now looking at lower returns, higher volatility, high inflation, higher unemployment, less stock market diversification, higher rates, less growth, higher geopolitical risk. So the biggest question here is, are the changes we're looking at in this slide, are these longer term or shorter term situations? Is this a blip on the radar, or is this something we're going to see for an extended period of time? If you've seen our other webinars, you know that we believe this is here to stay for longer. Let's say 10 years, maybe up to 15 years. By many estimates, this situation is what we're looking at. If you want to take a look at some third-party data from some big names, take Morgan Stanley, take Goldman Sachs, two of the largest names in finance. They gave their predictions for over the next decade of stock market returns. Their predictions had annual stock market returns expected between 0 and 3% per year. And again, that's for the next decade, next 10 years ahead. And reminder, that's also with the diversification of the stock market declining, and also with valuations of stocks being roughly 38% overpriced, according to the CAPE ratio. So a lot of things can go wrong in the stock market in the near future, and volatility's through the roof on the 60/40 portfolio. So we got another poll for you guys here. What's your biggest concern with traditional 60/40 portfolios in the current economic climate? Take a minute and answer the poll. We want to hear from you guys. Love it. Great answers. Great answers. So, number one, all the above, a wise vote. Limited growth potential, lack of diversification options, vulnerability to market volatility. Number two was vulnerability to market volatility. Number three, lack of diversification options. And number four, limited growth potential. But the number one was that people were concerned about all of the above. I agree. Candidly, I could not agree more. I think all of these are a concern on the horizon here. So what does all this mean? Inflation combined with lowered long-term returns has diminished the ability of the 60/40 portfolio to keep up with investors' needs in today's market. Any way you look at it, we're looking at very modest returns ahead compared to historical averages. Adjusting for inflation does not help either. Even if we expect inflation to fall to, say, 1.5%, which I don't think anyone is really targeting right now, even if we adjust inflation to just 1.5%, the problem is still severe. And then if we factor in, let's say, a 1% for advisor fees, we are down with the average projected returns of many of the biggest groups. The expectation is between 0.4% annual returns on the low end, up to less than 2% projected annual returns. So the expected returns on a 60/40 portfolio are likely to feel very low relative to the last periods of time. Problem number two, the equity and bond correlations are turning positive. Okay. They're now in lockstep. For decades, investors relied on the negative correlation between stocks and bonds. When stocks fell, bonds typically rose, and vice versa. When bonds fell, stocks rose. What this provided was a natural hedge for the 60/40 portfolio. This relationship has fundamentally changed in the current market environment. Now, both asset classes are more likely to move in tandem, particularly in inflation-driven volatility. So as inflation moves up or stays above the Fed mandate, which is where we're at today, that correlation increases. That's what we're seeing. This is a structural core shift that undermines the core foundation of the 60/40 portfolio. Problem number 3, real yields are at multi-decade lows. So despite recent rate increases, real yields remain well below historical averages. This is especially clear with bonds. When investors can't rely on bonds to deliver quality returns, the ones that they're counting on for their portfolio, they're forced to make a tough decision. They either have to decide to allow their wealth to erode and take that path, or find a new investment opportunity in new markets. It's one or the other. This core shift undermines the income pillar presented by bonds. This undermines the income pillar of the 60/40 portfolio and requires a complete rethinking of how we approach fixed income allocations and investing. Now, a lot of people on every single webinar ask if you can invest with your IRA with Saint. So we'll take a minute and use our own income fund as an example here. We see a lot of investors do this, particularly retirees, because of how our return structure is set up, similar to some other funds out there. We've structured the income fund for Saint so that compounded investments actually make more for you, aka works well in an IRA account where you can't take those distributions anyway, right? So this allows you to get up to 14.28% returns, taking that compounding return option. So many people shift to compounding to get that higher return and boost the returns of their IRAs when you're in an environment where returns and yields are being squished down by traditional investments. So let's use the Saint Income Fund as an example, and let's dig into what we're seeing in the market today. I'll give you guys a second to look at the chart. All right, so let's bounce around a little bit and look at some of the winners and the losers of this chart here. First, let's take a look at real estate syndications. We're big fans of real estate syndications. You know, we're very proud of our own returns in the syndication space. But the reality is, even syndications, even with their lower returns at the current market cycle, are still crushing many of the other opportunities out there, right? The problem with syndications is the lockup period's a lot longer, and some of the best benefits of syndications are lost on IRAs. The tax benefits of syndications, certain distributions, etc., can't be fully realized when you're using a syndication for an IRA. You look at some other things. Let's take a look at the stock market, 10 to 12% historically. Again, this includes dividends. So without dividends, you might be looking at, let's say, 7 to 10%, and that might be generous if you're carrying that forward with some of the big groups' expectations. Now, historically, the balanced portfolio did pretty well. The 60/40 stocks and bonds did pretty well, right? You're looking at 9% roughly. But with the current expectations, it's a little more brutal. Also, you see bonds did pretty well historically. Those are much lower. We all know that bond rates, today you're looking at 4s for many of them. Again, highlighting the Saint Income Fund, 14.28%. The syndications, which are, probably my second favorite on the list, they have those higher returns, but those are primarily equity-based. Those are based on performance, whereas the Saint Income Fund is a fixed return. So when you start looking at equity versus fixed returns here, it's a good thing to consider when looking at comparisons. So let's say you want to take the step. You want to make the jump and convert your IRA to an SDIRA. We get this question often, so we wanted to break down the steps for you guys easily and concise. Step 1, identify your investment goals. Choose the asset types that you like, whether it's real estate, private equity, etc. Identify what you're looking to invest in. Number 2, choose a custodian. Select a custodian that supports your investment needs. There's many that have much easier setups. There are fees to consider, although they're not crazy. So choosing the right custodian is a big step. Number 3, open an SDIRA account. So it's completing the application, it's providing the required documentation to the custodian, checking the boxes that they require for compliance. Number 4, it's fund the account, transfer, rollover, or contribute your funds to the new SDIRA. And last, it's you tell the custodian. You are now in the driver's seat. You tell the custodian what you want to invest in and with who, and complete the transfer process. So to understand how we fit in the picture here, Saint comes in the process at the last step when you're telling your custodian what you want to invest in. So you direct your custodian, you work with Saint, we interface with them directly, and we can manage that process with them directly. This whole process, here's a good note here. This whole process takes roughly 2 weeks. So converting from an IRA, traditional or otherwise, to an SDIRA will take you roughly 2 weeks. The big question we get commonly is, why is real estate a popular choice for SDIRA investors? Real estate is one of the top strategies used by SDIRAs for many reasons, including real estate is a physical asset. You can identify the asset types you invest in, right? So you know physically what it is, and you know what type of investment, what physical building and the asset class that exists in. This is a great balance to non-physical assets like stocks and bonds. Historically, real estate has shown resilience with long-term appreciation rates, right? So it benefits from, not just the growth of the asset value, but also it has less volatility. So it has similar growth to stocks in the same kind of way, but less volatility typically. Also, the income generated from real estate can significantly enhance the overall value of your SDIRA. So often higher yields than bonds, for instance, with still very good stability. And then additionally, real estate is one of the best hedges against inflation in the market. In the inflationary world that we live in, and potentially much higher inflationary world we live in, this is a big concern we hear from investors, and we hear this all the time. It helps our investors sleep well at night knowing that their retirement is locked in with assets that can benefit from inflation and hedge against inflation along the way. So those are a few, there's many others, but this is a good overview of understanding why SDIRA investors choose real estate so often. This slide is a great comparison. So we really wanted to include it because it shows a breakdown between a standard, very, very common SDIRA portfolio versus a traditional IRA portfolio. There are huge names in finance, very well-known names in finance, using very similar breakdowns. And the chart on the left comes directly from a group called Tiger 21. In order to join Tiger 21, you have to have verifiable income you have to have verifiable cash, liquid cash in your account of over 10 million. So these are typically ultra high net worth individuals, extremely sophisticated individuals. Tiger 21's most successful portfolio breakdown, which is on the screen right now, they found allocates over 28% of their portfolio to real estate. This entire asset class is missed completely with traditional IRAs, especially those using the 60-40 portfolio, which you can see on the right. You can also see larger groups with even more net worth, groups with even more capital under the belt, groups like BlackRock that are getting away from traditional portfolio structures. BlackRock typically averages about 20 to 40% of their allocations towards real estate, essentially right in line with the Tiger 21 example. Also, for those keeping score at home, BlackRock has over 11.5 trillion in assets. So they may know a thing or two about portfolio strategy, especially on a large scale. The takeaway here is that the groups with the most to lose and the most to manage and that perform the best have portfolio structures that get away from the 60-40 portfolio. And they typically have high performing portfolios that are allocating around 30% to real estate investing. So one of the goals in all of our webinars is building resilience. What we call this is all-weather portfolio investing. The goal is that if rates go up or rates go down, you have a portfolio that can manage it. If inflation goes up or inflation goes down, that you can manage it, and the assets that you're choosing weather the storm in all weather conditions. So let's take a look at something like an income fund. For Saint, the opportunity we are most optimistic about, that we feel is the best all-weather opportunity in today's market, are single-family mortgages. Why? Because they benefit in any rate environment. If rates go up, if rates go down, if inflation goes up, if inflation goes down. In the case of rates going up, you see a few things. One, you see that mortgages are more stable. People are less likely to move. They want to stick it out in the house that they're in, because if they move, their payment's going to go up, right? So for a mortgage portfolio holder like Saint, there are less refinances that we experience, which means cash flow is more stabilized on a longer term basis because there's just less turnover in the portfolio overall. On the flip side, if rates go down, this stimulates buying. More people are buying homes. More people are investing. Returns are typically getting boosted. As far as mortgages in a portfolio, typically we're seeing more trades. We're seeing people sell and refinance more, right? This is great for us. We're completely comfortable with this scenario. Imagine you invested in something that had a 30-year payout and then they paid you up front. Huge win. Returns go way up. And at Saint, we keep it pretty simple and just reinvest that higher return that we just got back on those investments. So all it does is expand the portfolio in a situation where rates are going down in the market. Also, quick check in here. If you guys want to learn more about investing with Saint, over 600 mortgages in over 29 states, we have a QR code here. Also, Ange, thank you. You dropped the calendar invite, or the Calendly. If you guys want to book a call with Tom to learn more about what we're doing at Saint, highly encouraged. We can walk you through our investment strategy. Tom standing by to book calls. And then also, Tom, do you mind dropping your number if they want to call you now and check in with you?
Perfect. Absolutely. Yeah, I'll put that in the chat as well.
Perfect. So we'll get into a couple fun things here. First off, our webinars are all on our YouTube channel. We have deep dive webinars across the board on various topics, investing strategies, economics, what we're seeing as projections in the future, market predictions that we see. These are all found on our YouTube channel, including we do up to the minute videos covering topics in finance, investment, economics, etc., of what we're seeing in the market today. They're quick blurbs, 5 minutes. We jump on and give you guys an update of the market. And then next, we have our next webinar on the docket for July 22nd. We are covering the future of the US dollar. On this webinar, we're going to cover the risks to the dollar, the opportunities for the dollar, the future of investing with global currency changes, and most importantly, what the status is of the US dollar being the reserve currency of the world, and if we see that changing. And last but not least, before we hop into our IRA FAQ, before we jump into our live Q&A, we're going to go over a quick frequently asked questions portion. We get a ton of questions. We've compiled these for you for the biggest questions we get consistently. These might help you navigate through your IRA processes. Number one, who are our favorite custodians and are some better than others? We work with a ton of custodians across the board. We've worked with very many. The number one thing here, if we're going to recommend any two, it would be Equity Trust and Advanta IRA. If you want to learn more beyond that, I recommend you get with Tom. He can walk you through that and give you some good insights along the way as well. But we have found that some are much better than others. So choose wisely during this process. And those are our top two recommendations. Number two, what do these custodians charge and how expensive is it to roll over? Custodians will charge typically a flat fee to manage an account. So unlike Fidelity, for instance, this is not based, the fee they charge is not based on a percentage of what you're putting in with the custodian. This is a huge advantage for anyone that has an IRA over about 50 grand. Now, as far as the fee goes, typically this fee range is anywhere from $200 to $400 a year, depending on the IRA custodian. So we're not talking about insane fees on working with these custodians. Another question we get, is there UBIT? Will I have tax, or will I have to pay tax on returns? I want to highlight this. The Saint Income Fund is not a tax advantaged investment on its own. Also, over the years, what we've seen is that people have some really advanced tax strategies, so we're not able to talk to the tax consequences of every single structure. But again, the Saint Income Fund is not tax advantaged. The best steps are to get with a CPA on this one particularly, because they might have some great strategies along the way that you can maximize your IRA. Here's the good news, and here's a good note, is that pairing something like a Saint Income Fund with a tax advantaged account like an IRA is kind of getting the best of both worlds. Great returns, above market returns, and having a tax advantage structure. And then also, will I pay penalties, fees, or taxes to do a rollover? Typically, there are no penalties or taxes. Some IRA custodians might charge like $50 to set up a fee or open an account, but typically fees, penalties, taxes, etc., very minimal on the fee side, and no penalties and no taxes. How long does it take for the rollover process? You're typically looking at a 2-week time period. So pretty minimal. Also, we can be in touch with you along the way. If you want to get both things rolling, investing with Saint and investing with and rolling over your IRA to a custodian, you could kickstart both at the same time. Next question. Should I give myself checkbook control? This is an interesting one. We're not really legally supposed to say yes, so we won't illegally say yes. But I'll say this to be very clear. We have seen this done in the past for our best and most sophisticated investors. Our most sophisticated and best investors that typically get the highest returns from their IRAs are giving themselves checkbook control. So it's something to consider. It's something to go through with your custodian. Only you can make that decision. But typically our best investors are taking checkbook control. Next, why can't Fidelity or Schwab or Merrill Lynch allow me to invest with you? So these companies typically focus on stocks and mutual funds. And the short answer that they do this, the short answer and the reason they do this is money. They're incentivized to do so. So they'll claim that the private market is a little too risky and push everything, and everybody back into stocks. That's kind of the simple game plan that they've leaned into. But what we've seen is that, especially over the last decade or so, that the interest in alternatives and private investing has gone up so much that even these groups are looking at the private sector, looking at private investment groups to start incorporating them into their menu. I don't see that coming up quickly. I think that's something that's further down the line, but even they are taking notice along the way. So can I roll over my 401ks or can I do a rollover with my 401ks and IRAs? Which retirement counts are not allowed? So let's go with the yeses first. Traditional IRAs, rollover IRAs, previous employer 401ks, Roth IRAs, SEP IRAs, those are all allowed. The only retirement accounts that are not allowed are current employer 401ks or current pension plans. Those are the only two that are not allowed of that list. And then here's a great question. Where do the returns from your investments go? So when you invest, where do those returns go? The returns will always go back to your retirement account, where they will continue to give you the same advantages of before. It's a